Thank you all for joining. So, good morning. I hope everyone had a good week so far. One more day to Friday. So, we have today gathered here for a session on ESG, demystifying ESG compliance and reporting in 2024. And we'll see what's the important in 2024 because things are changing as usual. So, there are some updates on this compliance requirements, especially for the Australian market. Just to make sure, I hope I'm audible and you're able to see the screen. Can I get a confirmation on that? Yes, all good. Thank you, guys. We'll quickly jump into the session and we'll take you through what we want to convey to you through this occasion. So let me move the slide. So welcome to this webinar that we are conducting on the ESG compliance and reporting in 2024. So I believe everyone here would know what ESG is because it's it's a very upcoming topic and it's has been in the industry for a long time now, and it's really important topic that we have to take into consideration given the current scenario. Now, we all know what's happening around the world in terms of a lot of issues happening around the world. If you take global warming, the pollution, the glacier melting, energy and resource crisis, those kind of issues become part of the environmental aspect of the ESG. There are other issues in the world that's related to poverty, hunger, safety, things like that, or related to the social collective that becomes part of the social commitment. There are other issues like ethical operations, corruptions, accountability, risk and compliance that becomes part of the governance aspect of what a business is supposed to do. Now, the world is looking for commitment from every country to do their part for a sustainable future. Every country is coming up with their respective targets for when they want to have what they want to have as a sustainable future and what they want to do with the net zero target. For Australia, we have a 2050 target, and we are also pushing for a 2035 net zero target as well at this point from all the materials that we have. So when a country comes forward with this kind of requirements, it's then looking for commitments from the individuals to do their part to be part of that movement. Now it becomes tricky to understand what focus area a business should tackle at that point. To make it a bit easy, we have the 17 Sustainable Development Goals that the UN has established, which we can target to identify those which are relevant for you and then work based on that. So business can identify what relevant commitment they can take up in for themselves and do their part. Now, at the moment, most businesses don't have a mandatory requirement, but there are businesses with a mandatory requirement based on their revenue or based on a customer requirement up their supply chain where they are required to report and they are asking us to be part of the commitment as well. Now, beyond that requirement from an external push, it's really important that we understand where we are heading as a human race and make sure we put our own commitment and take part in this journey and make sure we have a sustainable future. That's why this topic is important beyond a business perspective. So what we'll be doing in this session is going through the requirements of what ESG is today and then talking about some technical aspects related to this, which is the tricky aspects such as the carbon accounting and the life cycle assessment. And that will be part of the conversation today, and we'll shed some light and hope that is something that will help you in your future as well. Just to give a context who we are on, most of the attendees a few of the attendees at least who have joined are aware of Anitech and what we do. For those who don't know what Anitech is or what we do, we are a business of more than 20 years of experience in the risk and compliance space and occupational hygiene support and technology solution provisions as well. We have worked in the past with a lot of customers working with their environmental management projects, energy management projects, to support their sustainability journeys. And in the process, we have made a partnership with the EcoSolar Ties to support us with the technical support for aspects like carbon accounting, life cycle assessments, decarbonization projects, and we have fellow speakers from EcoSoltice who are supporting us in this session. So we'll go through all this. We'll go through some recent changes in 2024 that's potentially affecting the Australian market. And we'll also end with a roadmap to ESG compliance and reporting, and also tell you how we can support you in your journey as well. So that's what we intend to do. Just a quick heads up, we're having a 30-minute Q&A session at the end of the session. So if you have any questions, we'll consolidate and we'll have that covered there. But it'll also, if you have a question, it's also a good idea to put it in the chat so that we can have a look at it together at the end, so that we have a flow, a continuous flow during the session, and we'll spend that last 30 minutes to go through any questions that you may have. So I'll start with the introduction of the speakers today. So first of all, I'll just introduce myself. I'm Sanjay Shivakumar. I've been part of Anitech for the last 5 years. I've been part of the risk and compliance space. I'm having a background in the energy management space and renewable energy with a master's in the same from Monash University. So I've worked with several customers across Australia, UK, and New Zealand, and supporting them in their risk and compliance requirements, including sustainability projects. So that's me, and I'll let the others introduce themselves, and we'll kick off. Clarence, would you like to go next?
Yes, hi, good morning, everyone. Thanks a lot, Sanjay, for the kind introduction. Good morning to everyone, and I apologize if I am unable to turn my screen on. I'm facing some technical challenges here. Appreciate your kind patience and understanding on this. So my name is Clarence, and I'm the founder of EcoSolar Ties. It has been a great pleasure for me to be here together with Anitech and to co-host this event together with them on ESG. The purpose of this entire webinar is to give you a very high level understanding of what it takes to do carbon accounting, life cycle assessment, and the compliance of ESG. So I got two wonderful co-workers here with me today, my colleagues Stuart and Carol. Both of them are experienced practitioners in the ESG and carbon accounting space. We are very much a carbon management and decarbonization organization and company. So we are more than pleased to answer any questions and to help address some of your concerns as well. I will now hand the time over back to Sanjay, and he will continue to introduce the rest of the speaker. Thank you.
Thank you, Clarence. I'll let Stuart jump in.
Yep, thanks, Sanjay. Hi, everyone. So my name is Stuart. I'm now based in Indonesia, but I used to work for KPMG in Singapore and South Pole in APAC. So I work with clients across the Asia Pacific region, including Singapore, Australia, on their carbon accounting, so scope 1, 2, and 3, as well as the ESG strategy. So I now co-found an Indonesian-based company called Merahi Climate. We focus on transforming the ESG for companies who might not understand ESG. So we try to make ESG easy for SMEs and unlisted companies. I myself have education in environmental sciences as well as sustainable energy. Back to you, Sanjay.
Stuart. Carol, can you jump in?
Yeah, hi everyone. I'm Carol and thank you, Sanjay. Hello everyone, I'm Carol and I'm working in more specific in GHG accounting area and life cycle assessment. And I have previously worked in PwC mainland China. So same as my college, I just have some experiences in the ESAP area. And now I'm currently working in a public sector to help my clients to compliance with kind of sustainability policies or their compliance in the international area. So basically my experiences mainly focus on some like chemistry area and the textile or the industrial area and the energy. Based on my academic background, I just finished my master's degree in the Liverpool University in the UK. So yeah, this is all of my brief introduction. And back to Sanjay.
Thank you, Carol. We'll jump in. So I've already given an introduction who we are, so we'll jump to the next slide. So next is a quick poll. It should pop up on your screen. Do you have, we're giving a 60 seconds just to keep a record. So I request all to just give their feedback so that we can just get a census on where we are. So we'll have a few of these polls as we go ahead, and everyone will be able to see the response as well. This just gives you an understanding where the others are at, and just gives a consensus what scenario we are all in at. Okay, we can see the polls moving around. That's interesting. We need a bit more response. Okay, guys, we are almost at 50%. We are expecting, we're giving another 15-20 seconds. Yes, I think that should be. Any more responses? Okay. So we have a lot of yes there. That's interesting. And there is more interestingly, there are a lot of responses on not sure. That's something we need. That's something we businesses have to understand and have to take charge as well. Good to know. That's good. We'll come back to this. Thank you, guys. So moving to the next slide. Stuart, you can take it from there.
Thanks, Sanjay. So yeah, so for this webinar, we'll talk more about ESG in a high level and what requirements will apply to companies in Australia or even in Asia. But basically, maybe for all of us, or if not most of us, we're quite familiar with the word ESG. So it's environmental, social, and governance. But actually, the ESG itself has evolved quite significantly over the past few years. So for example, when I started working in environmental space about more than 5 years ago, the conversation was often revolving around CSR, so corporate social responsibility, or even just the ENS, just the environmental and social. There was no conversation about the governance and how it affects the environmental and social performance of a company. But ESG itself has been quite, I guess, trending in the past maybe 2 to 3 years, just because of more awareness about ESG from investors, customers, governments, and all the stakeholders involved from the company's perspective. But basically, ESG itself now is being seen as some sort of a risk and opportunity for a company. So one example I can give you is, for example, for a company in Australia, there might be a risk of heat wave, right? Heat wave might affect the productivity of a company or the employees, and this is seen as a risk for a company. We'll talk more about this risk and opportunity for a company, but just to give you sort of a high level understanding of why ESG is seen as important now in the current landscape. And for a lot of the big companies, there are so many ESG topics to choose from, but they do have to prioritize on what they see as material or important to the company, just because of limited, limited budget, limited resources, limited employee. So we do have to prioritize some of the ESG topics. But for a lot of companies in APAC, at least from my experience, a lot of them see them as opportunity. So opportunity, for example, is to get more financing from investors or even to get some competitive advantage from customers in APAC. Next slide. So as Sanjay has mentioned before, we have this, I guess, framework called the UN SDG, or the Sustainable Development Goals. So this was kind of made in 2015 by the UN, and these are the 17 goals covering all the ESG metrics. So for example, poverty, well-being, climate change, biodiversity, social equity. So these are the UN SDG that you can align to. You don't have to choose everything, but for a lot of clients I've worked with, they look at what is important to their operations, important to their stakeholders, and they choose what is relevant to them. Next slide. So again, ESG itself is a broad topic. There's no one thing that defines ESG, but it covers everything from environmental, social, governance. And I think for environmental and social, it's quite clear in that sense, because we know it's carbon emission, for example, energy efficiency, waste generation, or health and safety, indigenous community rights. But for some topics, it might be less clear. So for example, for governance, topics include no corruption, shareholder rights, the executive pay. So these are less obvious, but regardless, nevertheless, they are important to define a company's ESG performance, and this will all affect one another. So without a proper governance, a company will have maybe negative impacts on the environment and social aspects. And we'll give one example in the next few slides on how a lack of governance from a company will have impacts on their stakeholders, on the environmental and social impacts. Next slide. Okay, so we'll give examples of social and governance ESG topics. Maybe it's worth noting that a lot of the conversations that happen in this current landscape is on carbon emission, so net zero, right? But there's a term called the carbon tunnel vision, where it basically wants the companies, regulators, consumers not to get too fixated on just carbon emission. So we have to look at the other parts of the coin, which is maybe social and governance, including health and safety, labor practices, the indigenous community rights, business ethics, the risk management process. So these are all important as well, and they are not just they're not less important than carbon emission. And I would even argue that they are of the equal importance, right? So for example, for social, maybe in the case of a mining company, I understand that mining industry is quite a huge one in Australia. So I've worked with mining clients before in Indonesia, and a few of the important ESG topics are, of course, health and safety. I would remember that they put like this data on around the operation side, stating how many fatal accidents they have, how many deaths they have. So these are obviously important to mining companies, right? And also labor practices and local community. The clients I've worked with before, they tend to employ the local community as well. So they involve them in the consultation process. They hire them as workers in the operation. So it's quite obvious that these are important to them, because they need the buy-in from the local community. So it's also what we call the social license to operate. Without buy-in from the local communities, then they wouldn't be able to operate optimally in that area. Other parts of the coin is the governance. So in some countries, there's quite a stringent requirement on no corruption. So for example, Singapore is quite strict on that. So no corruption on the big companies from regulators. So they do crack down on that. So that's important for especially the big companies and financial institutions. Another example is the critical incidents risk management. So maybe we've heard cases of mining companies who have fatal accidents. So maybe for example, the dam collapses, right, affecting the local biodiversity, the local people. And it's important for a mining company to have a risk management process where they identify all the risks involved with a mining operations and what are the mitigation measure, what are the avoidance measure to reduce the impact or even the frequency of these severe events. Next slide. So one example on how governance, the lack of governance, will lead to a disastrous impact is a mining company. I wouldn't say the name, but it's a mining company in Australia where they basically they destroyed an important site for the Aboriginal communities in Australia called the Juukan Gorge. The site itself is quite significant in terms of the archaeological perspective. So it has about 47,000 years of history, from the first inhabitant until the most recent history. And what happened was that there was a lack of public consultation with the local indigenous communities. And because of the poor relationship with the local Aboriginal communities, they just decided to blast the mine, right? And even though they have all the permits from the Australian government, but because just of the lack of the consultation, it led to a huge controversy with the company and the loss of trust with the public, not only the public, but the local community as well. And ultimately, the disaster led to the resignation of the CEO and the two other executives. But this basically showed how the poor governance, the poor oversight from the management on the relationship with the stakeholders will lead to this kind of poorly made decision that will also have negative impacts on the local and the indigenous communities. Next slide. Or maybe going back to the topic of ESG. So we know ESG is important, but why? And this will differ from company to company, from country to country. For example, in Singapore, the ESG regulation is quite stringent. So for a lot of the listed company, at least from my own experiences working for Singaporean clients, the number one factor is regulatory compliance. So for companies that are listed, they do have to report their sustainability based on the latest standard. And otherwise they will get a fine from the Singapore Exchange. So this is also a risk, but also an opportunity for them to show to the public, to the regulators, to investors that they do care about sustainability, that they can make an impact on the ESG space. But for a lot of clients I've worked with, some of them, they do want to access financing from financial institutions like banks, venture capitals, and increasing a lot of these institutions are requesting for enhanced ESG strategy. They want to see the metrics that the company is looking at, not only carbon emission, but also the social impacts, right? Some companies that are bigger in that sense, they are looking into ESG to minimize the risks involved with the operation. And also, I think for the last factor is for the younger people, I think for such as myself, a lot of the companies that we look at, we also want to resonate with the values. So the Gen Z millennials, we do want to work for companies who care about the environment, care about the people, that are not doing anything, negatively impactful to the greater society. So if you do want to, attract, high skilled talent, I think ESG is also an important factor. Next slide. So I've worked with clients on their ESG journey. So it's not it's not like one phase journey. So there are multiple phases to basically looking at ESG, understanding ESG, making ESG strategy, and implementing ESG. So these are quite, in a sense, simplified. But usually with company, they would start with assessment phase. So they look inwards into their own organization, into their own process, policies. What have they done in the sustainability space? What are the ESG factors that are important to them? So there's a term called the maturity assessment. What is maturity assessment? It's a process where they look at all the ESG factors and then determine what is important to them. So again, like I said before, for example, for mining, they would look at health and safety, they would look at labor management, they would look at maybe let's say biodiversity as a material factor. But maybe for manufacturing company, biodiversity is not important. So once they have determined what are the factors that are relevant to them, they will look at the standards and framework. So we'll get to that in a bit, but there's a lot of standard framework, and they have to prioritize the standards that they want to focus on. Once they have this strategy, they can then implement it. So for example, they can conduct a change management workshop, they can educate their employees, they can make a sustainability team, they can assign roles and responsibility to the different departments and the different teams. Once they've implemented this, then it's important to keep track of the ESG progress. For companies that are maybe listed, that are required by the regulation to report, then they do have to report to the annual sustainability report. Next slide. So standards and frameworks for ESG is, there's a lot of standards and framework. In next slide, I will show you what are the standards and framework. But just to give you understanding of what standard versus framework is, standard is a bit more detailed. So it does detail the methodology, how you should measure or calculate your impact, while framework is more high level. So it aims to contextualize the information and to give a bit of flexibility in the direction, but not the method itself. And next slide, we'll go through that in a bit. Next slide. So ESG is a huge bowl of letter of acronyms. So we have a bunch of letters that are associated with ESG. So we have GRI, CDP, ISSB, SASB, so a lot of acronyms that we have to remember. But at least from my experience, a lot of clients, they do like to focus on just a few of these internationally recognized standards. But of course, for a lot of companies that don't have the prior ESG background, they do find it difficult to navigate all these standards. And that's something that we can help with as well from Anitech and Ecolosolidize. But for standard, they are the most common standard that is being used by company around the world is GRI, the Global Reporting Initiative. It's I guess it's a non-profit organization that provide the different metrics and the different reporting guideline for companies to measure and manage their ESG impacts. For the framework, we have framework TCFD for climate risk, CDP also an NGO. So in CDP, they provide also another reporting framework for companies to measure and manage their climate impacts, specific on the climate. So like scope 1, 2, and 3, and for example, deforestation as well. So there's more focus on climate. And there are also a number of raters, rankers. I think the most important rankers will be S&P, MSCI. Yeah, those are the two biggest ones that we can see in the current ESG landscape. Next slide.
This will be a
All right.
poll again for everyone. It should pop up on your screen. We'll give it a minute, and I request everyone to give their feedback.
Yeah, maybe for those of you who are not familiar with the standards, you can pick not decided. But for those of you who have reported, I think it'll be interesting to see what standard you have followed.
We have some responses, and we can see that even though there was a lot of yes in the previous question where they have requirements, we can see a lot of companies have still yet to identify the right framework for them. And that's an important area where we can support as well. Oh, good. I think we'll wait for 10 more seconds. All good. Thank you, guys. We'll move to the next slide.
All right. So next one, we'll talk more about the mandatory sustainability reporting standard. I won't go into too much detail for the next few slides, but maybe just to give a few key points. So currently there's a recent new standard called the ISSB, the International Sustainability Standard Board, where basically they're trying to solve a current existing problem where there's too much of the standard and framework. So they're trying to not unite, but make a new standard that makes it like clear for the companies to follow, So from a company perspective, they don't have to be confused of what standards they have to use. They just have to look at ISSB, and the ISSB will look at the other standards and try to harmonize their own standards. So for example, for Singapore and Hong Kong, they have adopted the standards. Australia as well, they just recently passed the law adopting this ISSB standard. So a lot of these countries, they mostly focus on the large companies first, but this will have cascading effect on the SMEs and the smaller companies. I will explain in a bit more detail. And these are made by the IFRS. IFRS, if you're aware, is the, I guess, the governing body for the accounting reporting standard. And they are trying to basically align the sustainability requirement for reporting, as well with the financial reporting requirements. Why are they trying to align these two, sustainability and finances? Because I think a lot of people now, a lot of the stakeholders are recognizing that climate and sustainability will have impact on the financial health of a company. Like I mentioned before, if let's say if there's a risk of heat wave or flooding, then this will affect the finances of a company, right? And the SSB is trying to align those two fields. Next step, like. So the SSB, they are divided into two documents. One is the S1 and S2, and how they differ is they focus on, one is on the climate specifically, climate specific disclosure, and the other document focuses on more sustainability related disclosure. They are trying to give a transparent but holistic overview of a company ESG performance. And again, they're trying to align with the financial reporting of a company. Next slide. So we in Australia, they recently approved the Treasury Law amendments amendment bill, basically paving the way for the ISSB adoption. They do rename the ISSB to Australian Sustainability Reporting Standard, or the ASRS in Australia. But actually, to be honest, I'm quite impressed by how quick they have adopted this standard. The ISSB standard was released last year, but a lot of countries, including Australia, have quickly adopted this standard in their own national regulations. So this will have impacts, not on the bigger company, but also on the smaller companies. Because for the bigger companies, they now have to report on their scope 3 emission, which is their supply chain emission. And once they look at the supply chain emission, then a lot of them will start engaging their suppliers. They will start engaging their all the stakeholders in their value chain on how to decarbonize, how to reduce the environmental impact. So don't think that even though they affect the bigger companies, this will not have impact on you. For the smaller companies, they don't have to report on sustainability publicly, but if you get requests from your customers, the bigger customers, then you're incentivized to work towards your ESG practices. Next slide. So for the ASRS, they are divided into two documents. One is the ASRS 1, which is more focused on sustainability related information. ASRS 2 is a standalone document that is more focused on the climate risk and opportunity. So I think initially they wanted to make SRS 1 and 2 as mandatory in the first draft. However, after getting feedback from companies, from the public, from the different stakeholders, they have decided to make SRS 1 as voluntary. So if you do want to look at SRS 1, then you can opt to, but you don't have to. What companies have to follow is the SRS 1. It is a standalone document, and they have incorporated the relevant parts from ASRS 1. So you do have to, it's more of a complete document in that sense. But they are both aligned with IFRS, with the ISSB that I discussed earlier.
Yeah.
Next slide. So who are affected in SRS 1? So there are 3 groups that are affected with a different timeline. So group 1 is the bigger companies that have 500 million in revenue, $1 billion in gross asset, and over 500 employees. So they do have to report basically from 1st of January. So in this case, let's say your financial year starts from 1st of January 2025, then you do have to basically publish your report in 2026 for the financial year of 2025. And for the group 2 is a smaller company, but still quite sizable one with 200 million revenue, 500 million in asset, 250 employees. The group 2 has to report from 1st of July of 2026. For the group 3, again, smaller companies, and they have to report from 1st of July 2027. But again, regardless of these 3 groups, the reporting requirement will have effect on the smaller companies because of the domino effect I mentioned before. Because the bigger companies have to look at scope 3, the effect on the supply chain. So if it's something that you can foresee yourself getting affected by the regulation, there's something that can help you with trying to see how we can meet the demands of your consumers and stakeholders in the supply chain. If you do have to report to SRS, there's also something that we can help you to navigate, try to navigate the regulations, trying to look at the best practices in measuring your ESG impacts.
Yeah.
Next slide. Okay, so for this one, I won't go into too much detail. But basically for SRS 1, it's more focused on the sustainability related risk and opportunity. So quite a generic one, not only carbon emission, not only climate, but also your social and governance factors. What you do have to report, however, the ESG topics are those that are quote unquote that could reasonably be expected to affect the entity's prospect. So this can be, I guess, interpreted in a number of ways, different on the company. But for a lot of companies, this would mean, for example, having impacts on your financial. So if you mostly focus on financing from investors, then you have to see what are important to your investors. What are the ESG factors that are important to them? And without, if you don't, and you have to look at topics that are, I guess, like if you maybe I'll go back to what the quotation here, because it depends on the company to company perspective. And they also mentioned that if information is material, if omitting, misstating, or obscuring that information could reasonably be expected to influence decisions that primary users of general purpose financial reports make on basis of those reports, right? So let's say I'm an investor and I saw your report and I don't see some ESG topics, then I would question that, right? I would ask you as a company, why do you decide to omit this? And you do have to justify the omission of these factors. And if the investor decide that this ESG topic is important, then you do have to look into it further. You do have to possibly report that in your sustainability report. SRS 1 is based on the TCFD framework. So there are 4 pillars: governance, strategy, risk management, and metric. Example of governance, for example, is the management role in governing the climate related risk and opportunity. What are their roles? What are their processes? How much do they get paid? Are they linked to ESG metrics. So those kind of stuff that they have to report as. The second pillar is strategy. So a company does have to identify the climate-related risk and opportunity. So for example, in Singapore, one of the risks is carbon tax. So some companies are, they do have to report the carbon emissions, and if they emit more than 25,000 ton of carbon dioxide, then they do have to pay carbon tax. And this carbon tax does increase over time. So I guess the more they don't do this carbon emission reduction measures, the more they have to pay, right? So this is a risk for companies in Singapore. Other metrics include how the climate risk and opportunity affect the business model and value chain, as well as the financial performance. The third pillar is risk management. So again, the process and policy to monitor the risk and opportunity related to climate. And the fourth pillar is the metric. So metric can differ from company to company, but the most common one is the scope 1, 2, and 3. So they do have to measure the carbon emission in ton of carbon dioxide. Next slide. So SRS1 is more focused on climate, but ASRS2, they focus more on climate risk and opportunity, but they do incorporate some aspect from ASRS1. It still follows the same area, the same 4 pillars, but there are some additional requirements that companies have to look at. So an example would be strategy. So company does have to look at scenario analysis. In the Australian context, they do have to look at 2 scenarios. One is the 1.5 degrees Celsius increase, and the second is 2.5, I think, degrees Celsius. So they have to forecast how the different climate scenario and assess how this will impact the operations. A simple example would be flooding. Let's say if there's a flooding risk, then how does this impact the operation of the company? The next slide. All right, so those are some high-level introduction of the requirements of the different standards and framework. Next one, we'll move on to how to measure carbon emission. So carbon emission itself, it's not just carbon dioxide. So there are multiple gases that are included in greenhouse gas. So for example, methane, nitrous oxide, hydrofluorocarbon. So these are all greenhouse gases. But for simplicity term, we call them carbon. And there are some standards that are applicable in the current ESG landscape. One, the most common one is the ESG standard, greenhouse gas protocol. And the second one is the ISO 14064. They basically complement each other. But the greenhouse gas protocol, they provide more detail on how to calculate, where you can get certain data, what kind of assumptions you can make. And currently, they're actually trying to get some feedback from companies and stakeholders because they're trying to make some improvements to the greenhouse gas protocol, just because the standard itself was made like more than 10 years ago. So it's a bit outdated in that sense. But we can see some more revisions happening maybe in the next 1 or 2 years. Next slide. So with carbon emissions, maybe for those of you who are not familiar, the greenhouse gas protocol split them into 3 categories. The first one is scope 1, the second is scope 2, and the last one is scope 3. So these are all different. Scope 1 is basically your direct emission. So any emission that came from your operations, like company facility, your boiler, your company vehicle, anything that happened within your own operational area. So these are all scope 1 emission. For scope 2, this is indirect emission. So not your own emission, but these are emissions that come from your electricity, your purchase steam, your purchase heating, cooling, that happen in, for example, in the power plant that you don't own, right? But in a sense, you do have some control over how much you consume this electricity. So these are uniquely categorized as scope 2 because you do have some degree of control over this emission reduction. Scope 3 is your indirect emission from your supply chain, or sorry, your value chain. So upstream and downstream. So your procurement, your waste treatment, your transportation, your investment, your franchises, everything else are included under Scope 3. Next slide. So these are basically the same slide, but example of Scope 3 that I want to highlight here is raw material. So let's say you are a manufacturing company and you purchase let's say like plastic pellet from your suppliers. This will have some emissions from in your Scope 3, and typically the emission from Scope 3 or your raw materials or purchased goods are the highest. It can be about 80 to 90% of your total emission. So this is very important. This will be the most material for companies, and that's why we're seeing a lot of the bigger companies, they are engaging their suppliers to decarbonize their own supply chain. Other examples include transport, business travel, waste treatment and disposal. Next slide. So there are 15 categories with the Scope 3 emission. Not all of them will be material to you. So typically with clients, we try to understand the operation and the context of the company, and then we determine what is relevant to each of the, what Scope 3 category is relevant to you. For a lot of companies, it will be purchased goods and services, which is your emission from your raw materials, business travel, employee commuting, right? But for some companies, like for example, investment might not be material, just for the fact they're not a bank, they're not investor, they don't have any investment, right? So some of them will not be relevant, but that's something that we can help you with, trying to look at, try to understand your company context, and then filter what is relevant to you. Next slide. The difference between ISO 14064 and the Greenhouse Gas Protocol, even though they basically talk about the same thing, they do have different categorization. So Greenhouse Gas Protocol, they have 15 categories, but with the ISO, they have 6 categories. 4 categories for the Scope 3. So for example, for transportation, they define it under category 3, while for the use of products that they sell, it's under category 5. But they're basically the same thing. It depends on how you want to report that. Most companies, they do refer to Greenhouse Gas Protocol, so the 15 categories. Next slide.
A poll should come up to you. Just we are trying to understand where you are at identifying your scope. If you have already started, if not, let us know as well. Let's give that another 20 seconds. So far, the responses show a general trend that we are yet to start on. The highest percentage have yet to start on this phase. But it's interesting to see there are some responses who have already identified 1, 2, and 3. That's good. That's good. They have comments there. All good. We'll jump to the next slide.
Yep, thanks, Sanjay. So typically when you, in the next few slides, I will explain a bit more on how a company can measure carbon emissions. For this might be helpful for those of you who have not comments, but there are 2 boundaries that you have to be aware of. One is the organizational boundary. So which subsidiaries you have to include, which companies, which entities you have to include in your boundary. It's kind of the same concept as your financial reporting. The second is the operational boundary. So what are the 15 categories? What are the scope 1 and 2 emissions that you have to look at? So for the first one, the organizational boundary, there are multiple approaches that you can select. For example, the control approach, the equity share approach. So they differ in a way on how you define, I guess, your boundary. For example, for equity share approach, a company might look at the subsidiary. Let's say they have 40% equity in that company, then they just account for 40% of the emission. However, even though this is, I guess, in a bit more, it's a bit simpler in that sense. You can just multiply it, but these are difficult to track over time. One reason is, for example, if you have a company that which the equity change over time. So let's say from 40% to 30%, then you have to track them over time and you have to recalculate every time. So these are a bit more tricky over the long term. For the clients that I've worked with, most of them, if not all of them, they opt for the control approach, specifically on the operational control approach. So this basically means that for every subsidiary, every entity, every asset that you have you have control over, then you have to account for 100% of the emission, regardless of the equity. So if you can make operational decision, then you do have to look at the 100% of the emission. And that's also more aligned to your decarbonization, right? Because if you can make the decision to change an asset or install a certain policy, then you're accountable for that emission and you can make the appropriate emission reduction measure. Next slide. So actually calculating carbon emission it's not difficult per se. It only relies on a simple formula, which is your activity data multiplied by your emission factor. So activity data is your company data, basically. So your electricity consumption, your fuel consumption, and you have to collect them internally, possibly from different departments in your organization. The second metric is the emission factor. So emission factor, oftentimes people, companies, they get these emission factors from third-party databases. So for example, I think Australia has one about government databases for emission factor. The UK has one, the US has one. So you can source this emission factor and then just multiply them by your company data. And a lot of the times my clients, they face challenges with getting the internal data, simply because maybe the team only has like 1 or 2 people in the sustainability team, and they have to engage the different departments, the different teams, and this does take time to collect all the relevant data. Next slide. So emission factor is basically it's carbon dioxide in kilogram. Sorry, going back to the previous slide. Kilogram of carbon dioxide per your unit of activity data. So for example, kilowatt hour, liter, and you can get this from databases. And on the left, you can see some example of this emission factor for diesel and petrol. Next slide. So a case study is, let's say your company operates a diesel van, and then they travel 50 kilometers a day. Assuming it's something you can track. So what would be the emission? So you know it's 50 kilometers. So just multiply it by the number of days that it travels, and then you multiply it by the emission factor, and then you can get the emission. Ideally, the best case scenario is that you can measure them directly using, let's say, let's say a sensor in your van. But in most cases, companies don't have this data, so they do have to rely on emission factor databases to calculate the carbon emission. Next slide. Well, for scope 2, it relies on the same formula. For Singapore, we do have a published emission factor from the government, which reduces over time. Australia has one as well. And we just have to multiply the emission factor for electricity by your electricity consumption in kilowatt hour. Next slide. So this is the formula for scope 2 emissions. So let's say you use 30,000 kilowatt hour of electricity. You just have to multiply 32,000 with 0.4057 in the graph for 2021, and then you can get your carbon emission. Next slide. Yeah, so just have to multiply that. It's quite a simple formula, really. But I guess the challenge is for a lot of companies, a lot of my clients I've worked with, they are not sure what emission factors to get, or they don't have access to certain databases. And that's something we can help you trying to navigate, trying to see what are the emission factors that you should source. Next slide. So this is the emission factor for Australia, and it does decrease from time to time just because of the adoption of renewable energy from the grid. Next slide. We'll skip this slide because we have talked about scope 3. Next slide. Okay, so that's it for the scope 1, 2, and 3. I hope that's a good high-level understanding of how to calculate. If you do have any questions, we can discuss it after the session, the FAQ session. Back to you, Sanjay, for the, sorry, back to Carol for the LCA explanation.
Yeah, hi everyone, I'm Carol, and I will have some high-level explanation about LCA part here. So about LCA part, it is life cycle assessment so this is kind of like a fundamental methodology to use to like evaluate the environmental performance of a system. The system could be the organizations, or companies, or like specific products. So basically, we use life cycle assessment to assess the environmental performance of different kind of systems. So there is also some ISO standards here. Is very like recognized internationally, and this diagram is about the like different life cycle stages for a system. It is divided into 5 parts. The first part is raw materials acquisition. It is more things like from our upstreams. And in this ISO standards, we identified this kind of area as cradle because it is like the very beginning of all things. Like if you want to produce something or have some activities, we also need to extract of different kind of raw materials. Yes, and the next step would be materials manufacture. It is like a production phase. It usually happen in our organizations. For example, we manufacture of some kind of products. This phase would be happening in our factories. Yes. And so yes, the third step is tightly related to the second one. So we just do some processing work in our products or just happening in our factories. So we can see here the gate here. We almost identify the gate is like the gate of the factory. In many cases, we just finished our products manufacture and then like just sell them to the downstreams. So we just identify the gate here. And the next is the use stage. It is really easy to understand because if we just buy some goods, buy some products, we just need to use it. Like maybe we need to charge them, we need to wash them, or extra. And the last part is the end of life of this part of this system. It could be like we just dispose of our product. It is like in the end of life phase. It cannot be used in the future, so we just dispose of it. Or for a bigger system, for a building, we also need to dispose of it and need to deal with some waste by themselves. Yeah. So basically, this is the 5 stages of the whole life cycle assessment. And for the end of life stage, we just identified it like a grave. So because it is the end of the Q life. So yes, and for sometimes we could see there is a word here called ecological loop here. It also could be said like cradle to cradle, because in like some kind of manufacture process, we would use some like recycled materials. It might be come from the end of life of other products, but we can like use it one more time here. So it will create a ecological group loop here. And yes, this is this page, and the next page, please. Yes, And so if we want to do the life cycle assessment work, there is the four main phases of how we can like implement the framework. So the step one would be the goal and scope definition. The two is the life cycle inventory analysis, and the third one should be LC assessment. Yeah, and then we will have the result and we have some like conclusion interpretation here. So for the first step, goal and the scope definition, this is like initial part here, but it is really important because our work will start here. And go next, thanks.
That should bring up. Yeah, a poll should come up on your screen at the moment. We want to understand if anyone has a requirement in their workspace to do a life cycle analysis. At this point, there are requirements from a supply chain requirement where they are required to do life cycle analysis for any of their products or any of their raw materials that they do get. We'll give it another 10 seconds. Okay, that's good. We'll jump to the next slide.
Okay, thanks. So there is a simple diagram about to explain the 5 stages of life cycle assessment. So the first one, and there are some examples. So the first one is the raw material acquisition. Like for example, if we are a metal production factory, so for us, maybe our raw material will be steels, some rolls, some metal things here. So we just buy them from our upstream. And also you can see at the bottom here, it would say the data would be the upstream background data, also called secondary data. It means we cannot collect them by ourselves, or we just like collect them from, like ask for our suppliers to provide this data. And the next stage would be production. It would be happening in our factories. So we have the primary data. We can like just measure the electricity consumption and also some kind of fuels usage here. So the next step would be the distribution and retail part. Like when we finish to product our products, we need to like distribute them to different kind of retails or our clients. So we have transportation and also maybe have some storage, and maybe if for some goods like some products in the supermarket, maybe we need to have some retail parts here. And the next one would be the usage. Like for kind of time, we just need some transportation from retail place to our like usage factories or usage points, and then maybe some consumer will have a use of them. Like if this is a like washing machine, so we need to have it will consume the electricity, the washers, and different kind of materials here. And go to the final one, the disposal, or we call end of life project phase here. Maybe we just need to transport them to some specific place to do the disposal work, and then we just do the disposal work and like maybe just landfill it or do some kind of treat on them. So basically for this area, we also could just get the secondary data from maybe from the downstreams. So please go to the next page. Yeah, and also there is a like more complex example for us, and it means we need to develop a process map here. Basically for like, let's say we are the metal factory here. So we will know there is a very and complex process when we just want to manufacture our product. So basically we need to do some data analysis, and we just need to quantify all input and output by our process map, and also to quantify our environmental performance based on life cycle assessment methodologies. Yeah, but we will just do this kind of complex part for our clients. So no worries. Maybe we just need to collect the data and the information to us. That's cool. And go next page, please. Yeah. So we also have a sustainability pre-assessment tool in our website. It is used for GHG accounting. So the main aim here is, the first one is for identify data gaps. It is used to help our clients to know maybe we just need to collect more data, or maybe we just start to like measuring some kind of data here. And the next one is about resource planning. Yes, so the company could just like, they will recognize maybe we just need more employee to do the related things here. And the third one would be set realistic targets. So it is used to set the carbon emission reduction strategies and targets for us. And the fourth one would be improve the accuracy and consistency. Yes, because we need to collect the consistent data here. For the LCA accounting, because our time boundary always been 1 year or many years here, so we just need to confirm the consistency of the data. And also we need to do risk management because maybe we just have some gaps here, and we just need to pay more attention in the future. So the last part would be stakeholder engagement. Yes, maybe we just pay more attention to facilities meaningful engagement with our stakeholders like investors, customers, regulators, even if in internal parts with our employees here. So this is the main aim of our tool. We can just use it in our website. Next page, please. Yeah, and this is the advantages for our tools. We can just have a simple test of if we are in compliance with GHG protocol, or maybe we can just adopt different kind of requirements for us. And we are also there are some specific features of our tools. We have 5 sections for pre-assessment. This is really simple because you just need to select A, B, C, D here. So the first part is about climate-related performance, and to know more things about your companies. And the second one is we need to collect some information about the boundary setting. We will help you to set your boundaries in the future work. And the next part will be about scope 1, 2, and 3 questions. We will know some like what conditions you are in the data collection work, or have a comprehensive evaluation of this future work. So yes, and when we finish that, we will have a carbon accounting readiness index. We will have a evaluation results for you, so we can have a very basic understanding of our current work. So yes, and then we will have some gap analysis with data analytics and insight. It is used for our future work for you. And then we will provide some recommendations for GHG accounting or decarbonization work, like maybe we need to set some SBTi or sustainability goals. We will help you to do that. And please go next. Thanks. Yeah, that would be the readiness scoring breakdown. It is a result of our finish the evaluation in our tool. So yes, next please. Yeah, that and for GHG accounting, we also would provide the report and recommendations here. The specific contents are listed in the slides. We can read it. but I'm not going to go into details in here. So please go next. Yes, and we also would set the roadmap to ESG implementation. Like first step, we need to have the comprehensive assessment, like I mentioned before, and then we will have the tailored strategy development, and then do the implementation work and reporting. And then we just go back to the first step, have the assessment and do the continuous improvement in the future. Yeah.
So
Next,
just just to give an update on this one as well. So this is we have also released a poll here just to see where you are at your journey. So if you can let us know what situation you are in, we just want to understand that. We'll give it another 30 seconds. Let's give it another 10 seconds. Okay, that's all good. So just to give an update on this slide, so like Carol suggested, there are different stages that we need to go through. There are highly technical in some aspects when we come to the environmental aspects particularly, and that is where we can support you in general on those technical elements more than the others. So the most important part again is to understand what you do as a business, or what is and assess where the gaps are and understand, and then tailor a solution for you. Because out of the 17 SDGs that we have seen, a business can't may not be viable to go for all 17 SDGs and tackle them all in the same attempt. So it's about identifying what's the most important ones where we have an impact on, and tackling a few at a time and closing one at a time, and then tailoring a strategy for that. How do we tackle those three that we want to support? Maybe a community activity, maybe on pollution, maybe on and biodiversity or something like that. So then we help you guys tailor a solution for yourself, tailor a map, and what we see is the business can take all the decisions and all the plans they want, but the hard part is getting the follow up with and follow on and getting it through to the next level of the business, to the employees, and to the next stages. So that's where we also come in with our background in implementing management systems and safety systems, environment systems. We have expertise in doing the change management aspects, implementing the system in the business, providing training solutions on site, and generating the training packages. So, and also integrating these activities along with your regular operation. It doesn't usually work when it's two separate activity. A division that's running with sustainability and you, the business, going in a separate route with your regular operation, doesn't sync very well. So we help to integrate that into your daily operation, and then it becomes part of the monitoring activities. It automatically starts generating data to support your strategy, and then at the end we generate the report and understand the best way to disclose the commitment and the outcome to the public as required by you. And then it's not just a 1 year thing. We let you run with the system, and but we come every year, we sit with you guys, understand how it's performing against your targets. If you're achieving it, good. Let's increase and set a better target for the next year. But if you're struggling at some point, what else can we do? Do we modify the target to suit what we can achieve, or do we add additional controls to make sure we can achieve the target? So this becomes a cyclic loop, and if anyone is already aware, experience with the ISO systems, is usually a PDCA cycle, which can be applied to any application in any business as is. So this is where we and EcoSolutize together can support you in your journey. You can see that a lot of people are already monitoring their requirements. Have a lot of people are not sure if they have a requirement. A lot of attendees are considering to start monitoring ESG. So there are a lot of area attendees that I believe are requiring support. So this is where we can support you guys. So we've already covered the poll. So just to give a closing note. So again, we have covered all of the technical aspects and also the other aspects as well. When you come to the SNG aspect, the social and governance, which is kind of a bit of a gray area for some businesses because they don't know what are good projects to come or take up for that business. Now, again, it depends on the type of business, their impact in the social and governance platform, their employee size, the labor size, the type of risk that they work with. That all depends, and that we can help identify based on the pre-assessment. So again, this is not just yes, this will bring no when we commit to this brings us a return on investment. It brings new investments, and and it's really important to see in a public space that we are committed to this, but more it's a personal commitment that what we are doing for a better future. Again, what this is, I think we have covered a lot of information now. So why start now and why start with us? So we have a lot of experience in the front end and the back end supporting a lot of customers. So for people who have been attendees of the session, if you have any requirement or if you want to have a chat, come to us. We have a special package planned for you guys from for the pre-assessment as well and for the ongoing implementation. So feel free to put in a word or just reach out to us and we can start a conversation to see how we can support you or give an assessment and tell you where you are at your journey. Like what Stuart said, it's not far where it's a mandatory requirement for many businesses at the moment to start reporting it. The companies or the business that will start early will reap the benefits when it becomes mandatory, and it'll be easier for the transition when that happens. So I think that's it. That's the concluding slide. So any questions that we want to have a discussion here? Any questions from the team or from the audience? I'll stop sharing.